Okay, so continuing on with Chapter 1 here, now looking at Learning Objective 5. Describe how the credibility of the accounting profession was affected by these irregularities, these kind of frauds, this misreporting in the early 2000s. This is a medium priority. That's important because we need to understand why we have some of the institutional structures we have now that resulted from these irregularities. And so basically in around 2000 we had this panel of audit effectiveness that made these suggestions to improve audits. We had a couple of significant frauds. There's one in 1999 that was right before this with what I believe was waste management that kind of shook some of the confidence in the auditor's ability to catch fraud. And we'll talk about later actually kind of what auditors' responsibilities are related to fraud, because it's not quite as all-encompassing as what most users would expect. Okay, 2001 we had Enron. That was a big, that went bankrupt. They were kind of the darling of Wall Street. They had a lots of earnings growth. Their stock price just kept going up and up and up. They were on the Fortune Most Admired list, number one at some point, but then things started to unravel. And there's a lot of things going on there in terms of what they were doing. One of their big problems was they started doing mark to model accounting. What they would do is they would sign these contracts. Right, they were in the several different businesses, but a lot of it was related to energy. They'd sign these contracts about delivering energy, and at the time that they signed the contract, they would estimate what the profit would be by fulfilling the contract. And then at that point, they would actually book the income at the time the contract was signed. So it wasn't at the time that they actually executed and delivered. Right, it was based on the date it was signed. And so, because mainly the executives at that time were convinced that getting the contracts was the hardest part. If we convince people to sign the contracts, that's the hardest part. Delivering it was easy in their mind. They were wrong, but because of that, it made their profitability look really good. Even though then what you have later is these contracts would become very unprofitable. And so you'd get this late kind of surprise relative to what they had estimated. WorldCom also was a big fraud. They basically were doing kind of the oldest fraud in the book, which is you take an expenditure that should be expensed and you put it as an asset, right? And that way it makes the income statement look better, and then you can depreciate that asset a little bit over time instead of taking it all in the period in which it was incurred, even though that was when good accounting would suggest you're supposed to do it, right? So those were a couple of big ones. There were several others, Tyco and several others that really kind of rocked the financial markets. And so as a result, we get the Sarbanes-Oxley Act in 2002, which had some pretty significant impacts in terms of what auditors were required to do, the biggest of which was related to internal controls, which we definitely will talk about throughout this course. Also, it created this new oversight board for the public accounting firms, right? So now we have PCAOB. I always wished it had been Public Company Accounting Board of Oversight. Then it could have been, the acronym could have been PCABoo, which I think would be kind of appropriate given that their job is to come in and audit the auditors. All right, we'll talk about them more as we go, but they're definitely parallels to how the SEC was formed. There's a crisis in the 1930s, or 1929, stock market crash. The markets do really poorly. It comes out there's some fraud, and then the government kind of tries to respond to all this outrage by creating the SEC. Very similar kind of pattern here with the PCAOB. All right, which, yeah, that's what that point's about. Okay, so that's Learning Objective 5. That's kind of how we got to our current situation of having the governance structures we do. Learning Objective 6, this one's not as big a deal. We're basically just thinking about the different types of audits and auditors. we talked about the financial statement audits before. So that's all the major financial statements: balance sheet, income statement, retained earnings, cash flow. Statement of shareholders' equity will be included in that. And then obviously GAAP is our criteria. The assurance professional are CPAs, and the users are kind of internal but also external stakeholders, right? And there's several different ones there. If we look at other types of audits, we have compliance audits. So the biggest example would be an IRS audit of an income tax return, right? IRS has auditors that come in and do those audits. Operational audits, which can be done by public accounting firms, where they're basically looking at the effectiveness of operations of a given part of the firm. Internal auditors can do that as well, or external auditors can be hired to do it. Integrated audits, which we'll talk about towards the end of the course, this is where we're basically going to, as auditors, look at financial statements and internal controls over financial reporting. So we're kind of doing both audits at the same time, and as we go through the course, hopefully you'll see how that makes a lot of sense, because at the end of the day, internal controls impact financial reporting, which is the focus of the audit of financial statements. Okay. Other types of auditors. Yeah, I mentioned the internal auditors. The GAO, which is a governmental body, they have auditors. Obviously, there's tax auditors as well. Okay, so moving on to learn objective number 7 here, medium priority. Let's examine the regulatory process of auditors, public and non-public. So traditionally, the AICPA established, before the PCAOB, the AICPA was the body that established auditing standards. Okay, and they also sponsored research. They published kind of best practices around audits, and they still have publications today, right? They kind of help manage or kind of oversaw the CPEs, right? Which if you become a CPA, you'll have to do every year. And so they they're a provider of CPEs and also kind of a validator, I guess, of CPE courses. And traditionally, there was self-regulation in the sense of the profession was meant to regulate itself, right? Auditors were meant to have such high standards that they would do a good job, and you could get disciplined by the AICPA or censored if you had too many audits that had problems with them, right? So traditionally, but a lot of this standard setting piece and oversight has been taken over by the SEC and the PCAOB more specifically. Okay, we'll talk about that. But kind of continuing on here, the AICPA still does have a standards board that issued auditing standards, and so there's a couple different kinds. There's the statement of auditing standards. That's where traditional financial statement audits would have to go and look for, well, how do I conduct the engagement, right? How do I execute the engagement? There's also the standards for attestation engagements, which are for anything that is attestation but not financial statements. So basically everything else, right, would fall under the SSAEs as far as attestation goes. And remember, we had kind of this examination level, and then we have reviews, and so there's a whole category, or a whole set of standards on how you conduct review services, as well as other agreed upon services. And so the ICPA has several different, has 2 different committees, and those committees promulgate, that's the fancy word, right, for issue auditing standards. Yeah, you can see the examples of the publications, the Journal of Accountancy, which you may have seen or read some before, Tax Advisor. The industry audit and accounting guides are actually pretty helpful. They can provide insight into issues around specific industries, right, in terms of the auditing and accounting issues that those industries may face. Those are actually pretty helpful when you go into public accounting, to make sure you're reading those and understand what's going on, because as you start to specialize, then those will be helpful. Okay, they also sponsor research studies as well. The AICPA does, and accounting trends and techniques is also pretty helpful. It kind of lays out what's pretty common among firms as far as the types of accounting methods they're using, and those types of things. There's CPE. Like I said, this is kind of a low priority, so you can kind of look at that at your leisure. Regulation, there's professional conduct code, and for individual CPAs, and for regulating the actual accounting firms, there's a whole separate area for that. And so the AICPA still does look to regulate public accounting firms, even though a lot of that's taken out of the PCAOB. The CPA exam, which you will likely study for and hopefully you will pass. Obviously, it's a uniform exam. We have 4 different sections. But your state board is the one that actually issues you your CPA, right? And so they agree that the uniform CPA exam is kind of the basis. All the state boards agree that they'll take that as evidence that you are knowledgeable, but then they usually have experience requirements and education requirements on top of that. How does the PCAOB fit in? Well, they basically have a set of standards around these different areas, and we'll talk about these more as we go, but ultimately they're overseeing and disciplining the CPA and CPA firms that audit just the public companies. So the AICPA is still in charge of audits for private companies. The PCAOB is basically overseeing audits of public companies, right? And so there's a process to register as an audit firm with the PCAOB. They're going to go and do inspections of those audit firms to make sure that the auditors are actually conducting audits according to their standards. They're going to investigate when there's problems and potentially discipline, including unregistering the CPA firm and not allowing them to do any audits of public companies, right? So they have some pretty significant teeth as far as oversight and potential discipline. Obviously, the SEC is a government agency, and they oversee the PCAOB. And their goal ultimately is to protect investors. And really, let's be clear, it's to protect the voting public, right? That's what they're trying to do, is provide political cover at times, and make sure that there isn't outrage among individual investors in terms of how the markets are conducted. And then there's a whole set of statements you have to file with the SEC if you're a publicly traded company, in terms of your registration statements, in terms of your annual reports, 10Ks, 10Qs. 10K is the annual report, essentially annual filing. The 10Qs are quarterly filings, and so there's a whole set of information that you have to submit to the SEC if you're a publicly traded company. And so then auditors provide a role in making sure that information is valid. All right, so our last learning objective is learning objective 8. Describe how public accounting firms are typically organized and the responsibilities of auditors at the various levels in the organization. So you're no doubt familiar with the fact that there's different kind of categories that we talk about public accounting firms. Local firms, they're local to Charlotte, for example. Regional firms, maybe some that just operate in the Carolinas. We have national firms like BDO and RSM, Grant Thornton, Big Four firms everyone knows about. And then there's alternative practice structures. These would be like networks of CPA firms. Oftentimes there might be a common brand they share. There might be some profit sharing, might be some quality control in those. Those are not as common, but they do sometimes occur, especially in other countries. And then for typical national CPA firms, you kind of have this hierarchy. So when I was working for Big Four, we were just called staff accountants or staff auditors. Now you get a fancy title like associate, senior associate, that kind of stuff. Now obviously there's a lot more staff and associate level individuals that are doing the daily work, but there's definitely this pyramid structure, and so this is a common way there's a division of labor here, right? Partners are mainly focused on getting new clients and maintaining relationships and doing some oversight, making sure there's not going to be excessive risk that the firm is taking on by conducting the engagement. The managers are going to be kind of running multiple engagements, but a lot of times on the ground is the seniors, right? Making sure that day-to-day activities are being done, and that the staff or associates are actually conducting the work they're supposed to, right? So that's a typical structure of these national CPA firms, and even regional firms often have a similar structure.